All
Hello,
right,
everyone.
recorded.
Good afternoon. Thank you for joining us up on this on my new YouTube channel, where my goal would be over the next 1 year would be to do high level research and research highlights on companies, as well as bringing guest interviews, whether they be from Wall Street or from Fortune 500 companies, for them to share their key insights on companies and reports as well. So over the next couple of months, I'll be really happy to do this more often on my YouTube page. So definitely try subscribing to my YouTube page. So for today's interview, I'm really pleased to be having Henry Chan. Harry Chan. I hope I pronounced that correctly.
Yeah, Henry Chan. Yeah, no, it's all good.
Henry used to be a sell-side equity analyst up on Wall Street, and just quite recently he just did a 10-year anniversary actually, after working over 10 years, and he's even amazed that like working that long in equity
That's
research.
too
And
long.
so he has a ton of insights, a ton of just so much experience that he really could bring to a lot of retail investors. And so that's really my goal. That's my objective to today's interview. Is we're going to break this into two parts. The first part would be I'd like all our guests to really get to know Henry a little bit better, get to know a little bit about his background. And then next, we're going to really talk about a lot of his equity research. So we're going to speak a little bit more about those and maybe give people a little bit more understanding about what the job entails, what are the highs, what are the lows, and what's a day in the job like for him. So, and we're going to maybe do a little bit comparisons to the investment bankers on the other side. So that's the first part of this interview. And then the next part of this interview would be really just focusing on his book. So he actually just wrote a book, an amazing book. I actually just went to the book quite recently. And in his book, which is called Wall Street Investing, where he really provides all the insights from over 10 years of dealing with institutional investors and cranking all the research, meeting management teams as well. So he really provides a ton of research that I actually recommend people actually do check out the book. I highly recommend those to people to do that. So the next half of this interview, we're going to really talk about what are some of the key insights he's learned from institutional investors. What are they looking for? What moves stock prices? And some of those key insights for retail investors. So without going too much deeper, we'll get right into it. So Henry, thank you for joining me today.
Yeah, no, great to chat with you and chat with your
Thank,
audience.
thank you. Yeah, so maybe first of all, let's start with your background. Tell us a little bit more about Henry.
Okay, yeah, sure. So, I mean, I graduated from Brown, back in 2009, and I actually started.
Go.
Okay, yeah. So I started in 2009. I graduated from Brown. So my first job was actually I was a market structure analyst. So I was creating research around the infrastructure of markets, things like electronic trading, um, the impact of new trading technology and behavior and regulation around markets, really for trading desks at investment banks. So that was my first insights into the workings of markets. Then I moved to be an equity research analyst for the past couple of years, really, which is crafting research for institutional investors. And so my coverage was business services, education, environmental services. And so as an equity research analyst, we provide, really insights and data around sectors and companies, build financial models, and give recommendations on trade or investment ideas to institutional investors. And as part of that, since we're talking to companies all the time, we're talking to the buy side all the time, we also support bankers usually to help to understand valuations and industry trends for them to go to corporations to advise on their capital raising. So that's my background. And, I left the industry a few months ago. One of the things I saw, like you, is that there's been a lot of signs of a new generation of investors coming to the market. And I've always wanted to do something entrepreneurial. I've always been interested in creating my own company and building products. So I figured it's a good opportunity to just share the lessons that I've learned in terms of, the structure of markets, how investing works, and especially like the tools and the concepts that I've picked up to pass that along to investors that help them accelerate their learning, save some time, figure out better ways to make money. And so that's why I started with the book, which is just released, that we can hopefully talk about and share some insights that can help people invest better.
Awesome. I thought it was a great book. A lot of insights, really well distilled into key action points in the book. So I really, really love the book. But just a little bit more in your background. So you probably came out 2009, right after the financial crisis, or just thereabout. What was that like around that period? Did you guys have situations where maybe lots of investors didn't trust your research at all? Like, just tell me a little bit about how was it like kind of starting your career around the financial crisis?
Yeah, I mean, so the first thing was that there wasn't a lot of jobs, right? Like everyone's getting fired.
Yeah.
I mean, it was a time of a lot of change, right? So at that time, I was more focused on market structures, and so what was going on was this was right when high frequency trading and electronic trading started to really accelerate. So like right around that time, if you remember, like UBS had like a trading floor that was the size of a football field, right? Like now that trading floor is basically gone, right? Like the trading floor shrank from like 1,000 people to now it's probably like, I don't know, 10, 20 per asset class. And so you could see that start to change the markets. I think like maybe 2010, 2011, with HFT trading and electronic trading really becoming the dominant driver of transactions in the market. In 2010, there was something called a flash crash, if you remember, but that was just one day without any catalyst, anything happening. All of a sudden the Dow, I think, was down, I don't know, something like 20 points in like half an hour. And so you just like a crazy shit.
Yes.
But that was just, an example of what was going on at the time. It was just electronic trading was starting to change the whole game.
Awesome. Yeah. It must have been a pretty wild time, right?
Yeah.
So maybe it was really, really interesting. Tell me a little bit about, so this is just for retail investors who might be watching this and who might not know too much about maybe kind of that equity research analyst job. Maybe give us a little bit about what was it like? What was the day like in the job? Maybe just give us a little bit of insight into the actual job itself, just for people to learn a little bit more.
Okay, yeah, sure. So, I mean, you think about it, so equity research, you could maybe split it into like three ways. So maybe like a third of your time, you're really just talking to clients, right? So you're talking to traders, you're talking to investors, you're just talking about the stocks that you cover and the industries that you cover. And then maybe a third of the time you're on the road, you're going to see investors, you're taking companies out or management teams to go see investors. And then maybe another third of the time, you're really just sitting down, just, writing research, reading filings, reading industry journals to try to, that's where you're like proactively learning about companies and industries. So the day-to-day really depends. I mean, so, I guess like half of the time is more proactive kind of research, right? You're scheduling calls with consultants, or you're talking to investors about an idea, or you're just doing reading. And then that's how you start to develop research around a company or research a theme in an industry. And that's sort of distilled down into a written product, which of course you then distribute to the sales force and you start pitching it around and calling investors. And then the other part, which I guess is the more exciting part, is when you're reacting to things, right? So like a company, all of a sudden suddenly releases some piece of data, which no one's really prepared for about like their company, and all of a sudden the stock's down 20%, right? And so then, as an equity research analyst, you're getting a call every second from every investor, like, what's going on? And, because you're the guy who knows the stock, the industry, so you have all the context. So you're the one who, makes the opinion right away, right? So you do some quick calculation. You figure out, okay, so it's probably going to impact the stock this way. Usually people are going to be like, should I buy it or should I sell it?
Right.
But you have like a quick valuation of it. You put it, you take that piece of information or that change and you put it into the context of how the company works and how the industry works.
Yeah.
And then, so then that's when you have like your quick thinking on your feet, come up with the view. And then usually, on those days, the company will start calling analysts. They'll have a conference call. So you'll have like maybe an hour to listen to what they're, listen to their understanding what's going on, asking them questions. And then, you probably update your financial model, come up with the change to earnings estimates, probably come out with a new price target, write a note. And then you go on the morning call, right? And the morning call is like the every day, depending on the bank, but like 7:30, you're talking to the sales force, you're pitching, like in 30 seconds, what you learned and what you think is going to happen to the stock. And then they go out and talk to all their clients. So, 100 investors, all getting that research, and you line up more calls and you're talking again. And so that's sort of like that's sort of like more an action-packed day for a sell-side analyst.
That's awesome. That's interesting. Tell me a little bit more about what does it look like around earnings season? I know one of our conversations, you had mentioned earnings seasons could be one of your most hectic periods. Tell me a little bit, what does that look like around? Are you going through the same process, pretty much the same process?
Yeah. So you're going through the same process, right? So, I mean, we covered like, I don't know, it was like anywhere between 30 to 40 companies at one time. We covered a lot. We had a team that covered a lot of different companies. But, when you have 20 or 30, right, and they're all reporting within 1 or 2 weeks, right? So you might get like 4 or 5 a day. So 4 or 5 a day, you get like an earnings release, right? So you get the numbers coming in. And the buy-side analyst also has to deal with this as well. But, you get all these numbers come in. You have to, like, the first, when the release comes out, the first thing you're checking is like, all right, so how is this going to impact the model? Our earnings estimate is going to go up or down. And then that's going to be like, that's going to essentially going to drive, is the stock going to go up or down then? So, right. So there's the first similar thing, your flash kind of analysis. But then you have to then you listen to the call for an hour and you kind of listen to their commentary, trying to figure out, like, they also give guidance about, what their earnings will look like for the next quarter, for the next year. So you're also picking up these little clues, right? And then of course you update your model, you put in the new information, you write about what happened in the quarter and your view and how that's changed. And so, I mean, that in and of itself is like quite a, exercise. But then what happens in a sales analyst, you get that all at once, right? So you have to do 20 companies in 5 days.
That's insane. That's insane.
So that's why it's quite brutal, because, like, you're like a human information processor. You have to process a lot of information. Really
yes,
quick.
right.
Everyone wants to know now, right?
Exactly. Wow.
So that's like the more brutal part of it, right? So that's just like a lot of hours. And then when you're done with your analysis, you get up 6 a.m. to talk about it again, right? To get on the call.
Yes. That's wild. Yeah, that's interesting. Maybe we could even use this point right here to maybe differentiate a little bit about like investment bankers. So there's quite some differences between both. I mean, they're usually, I guess, a lot of your investment bankers are usually on deals specifically, right? M&A deals, IPOs or whatever. And you guys are specifically research. But maybe give us a little bit of highlight on some of the key differences for people who might not know, who might just watch this for the first time. Maybe some of the key differences between both, and maybe similarities between both. Where do you guys work together? If there is any synergies.
Okay, yeah, sure. I mean, so bankers are pretty much, I mean, they're client focused, right? I mean, they're 100% client focused. They have their corporations that they cover, and like they get paid with transactions essentially. So they're going and they're supposed to be there to help the company. Either they have an industry that they cover, and so they build relationships with the CEO, the CFO, the treasurer, and then so they're there to help them or to advise the corporations whenever there's any kind of capital need or transaction, right? And so then maybe the company needs to raise some debt, wants to issue an IPO, maybe do an M&A transaction, and bring in like these specialty bankers who know about how to do these transactions really well. So, you know, so they're doing a lot of like it's a sales job. They're always selling. They're always in suits because they're seeing clients. And, you know, they do like very situational kind of, you know, analysis usually. I mean, equity research, right? So, I mean, we like bankers and equity research work together, right? Because equity research, you know, for bankers, we have the research that helps them get smart on an industry so they know what they're talking about when they talk to a corporation. We help them understand valuations. And I guess most importantly, we also help them understand how the buy side thinks, because they're not directly talking to investors every day. Like, you know, usually we are. I mean, they eventually do talk to investors. But equity research, so we're more focused on, I mean, the companies that we follow. We're a little bit more focused on the industries, and our client base is, well, when I used to be a sell-side analyst, the client base was really the institutional investors. So the people like, you know, Fidelity, Citadel, these hedge funds, these long onlys, the ones who are actually picking stocks to put in portfolios to create, you know, funds or implement investment strategies. So we're part of that process where they, you know, they have a strategy that they're, you know, that they want to implement, and they come to the sell side, and we're essentially we provide contacts, we provide research to help them in their investment process. I don't know if that kind of helps it, but
yeah, that does.
We're definitely more markets. Sell-side research is definitely more markets focused, focused on the stocks.
Very cool. Very cool. What was your, maybe tell us what are some of the highest points? What are like your good moments? So kind of go into kind of your good moments and the tough moments of like being an equity sell-side analyst. Tell me maybe your high point. It could be a coverage of a company. I don't know. Maybe what was your favorite company that you covered? I know you always talk about MSCI as like
Right.
of your or give us a little bit about what was that all about? Maybe your highest point or a specific company you covered. What are some of the good things that you really love about the career? Maybe someone who might be one of our viewers might be someone who's interested in a career in this line. So maybe give us a little bit about what are the high points and a specific.
Yeah, sure. I mean, so, you know, like with sell-side research, right? So I guess like with anything in finance, right? When you start out, you're mostly just doing that, like, you know, reading filings and doing models. Like it's mostly due diligence. But as you become more senior, you start spending more time talking to companies. You start spending more time talking to clients. So it's just cool if you're like, it's a cool thing in sell-side research, right? So like MSCI was like a stock that I really liked. I thought it was a great company. You know, I would be talking with like a PM who was running a strategy, or well, I would talk to anyone from a PM to like even an analyst who's building the model. But you talk to all types of investors, you know, like hedge fund guys that are trading the quarter, you know, value people, value guys that are just trying to get swings in like really cheap stocks, or like, you know, a hedge fund or a long only that wants to do like a long-term view and invest in MSCI. So it's just cool that so you become part of their process, right? Like they call you to get your view, and so that you can provide context around the stock. Like MSCI is like understanding what ESG is and how that's going to drive the valuation, how that's changed the company, and so on. And it's just cool because you're part of that process for them, and you get to see all the different types of investment strategies that are out there. And you're, you know, ideally you're useful to every single one because, you know the stocks and you can provide the context.
Right. That's very cool. And I guess there's a lot of learning that comes from the job. I mean, you have to be someone who really loves to learn, right?
Oh yeah. I mean, you have to be interested in the stocks. You have to be interested in learning.
Very cool.
Yeah.
And what division did you work? Were you in TMT? Were you in commodities, or what side? What division did you specialize in?
Yeah, so I started with education. So I saw the whole boom. I came in right when the industry was about to bust, right? So it was like 2011. It's just, you know, because for-profit colleges rode this huge demographic boom, right? In 2011, this was when Obama came in and started these, you know, regulations that are clamped down on the for-profit. So I just thought, so I saw the whole thing, right? I saw growth stocks of education stocks, and they come down. I saw all the shorts just selling these stocks, and now all of a sudden it's a value stock, right? I did that, and then that industry was kind of a dying industry. So then started to shift more focus to business services. So I had like a nice mix of like there's staffing, which is like quite cyclical, information services. So that's like a MSCI. So that's like almost a tech business services, B2B kind of companies. Did a little bit of payroll, so stuff like ADP, which again is kind of cyclical. And eventually, like 2015, started to pick up environmental services. So that's like waste companies, a little bit industrial kind of stuff. So kind of saw like a nice gamut of different industries, different business models.
Very interesting. Very cool. What were some of your difficult moments, toughest moments of the job? What are some of the low points?
Yeah, I mean, low points is like, I mean, earnings is definitely a low point sometimes, right? It's not that fun to do it over and over again. It's not fun to have to process that amount of information. And, you get tired of writing the notes eventually. That's pretty much it, I guess. Sometimes, I don't know, sometimes it's kind of lonely, I guess, if it's like, you're just by yourself trying to get through work. That's pretty much it. Yeah. I mean, earnings is probably the main one.
Yeah. I would imagine you're working crazy hours during earnings seasons, like getting like maybe 3 hours of sleep or something.
I mean, so I always got like eight hours of sleep. The one thing is like, we're not like bankers, right? Bankers, they just tell the junior people to start working like 5 or 6 and like work through the night, right? But you can't do that in equity research because like someone's going to ask you for your opinion and you have to think like at 7 a.m. in the morning. So you can't go on through because you're just going to be like, I don't know, like, like you need to sleep to be able to be sharp. So I never did that 3 hour sleep thing.
Very cool. Very cool. That gives a lot of context. Then I could see equity research analysts being a lot more level-headed and just being straight than bankers who could be a little bit, well, I mean, due to the work, right, that you're doing, right, they're probably
I mean, they're a little bit more commercial, right, because they're selling things all the time. They make money with their like literally by getting transactions, right? Sell-side research is like a little bit more thoughtful. You have ideas. It's more about like communicating it well.
Yeah.
Yeah.
Very cool. Very cool. So we had a couple of people who sent questions over Twitter.
Yeah, sure.
I did put up a few questions over on Twitter just to get prior to this interview, so we're gonna take time to maybe answer a few of those questions. I think you probably hit on some of those already in our conversation already. But I thought maybe one of the questions we could even get started here was where do you guys source your ideas from? So for example, on your team, you have specific companies you're covering at a specific time. However, there might be a new IPO that's around the corner or something, or there's a company that a lot's going on. Maybe there's a shift in the change in the business model that might be. So how do you guys source your ideas? So that'd be one. And then once you sourced an idea, a new idea for the team, how then do you guys conduct your research? What does that process looks like in your research process? So
yeah. I mean, so ideas can come from a lot of places, right? So a lot of the times it's just what the company is telling you, right? So sometimes there's just something going on with the company, like they have some sort of transformational change, and that's like a very easy, clear idea. So then your job is, they're saying that we're going to change, and then your job is to, think through and, put a more critical lens on like whether or not this transformation is going to take place and what valuation is that going to bring the stock. Sometimes, like for example, if you're like a hedge fund focused type of investor, like it'll come from like your financial model, right? Like you're looking at estimates from the sell side and you're looking for, some sort of change, whether that's from reading the news or following the industry that leads to, this earnings estimate is either too low or too high. That could be from like a company, like its margins are over earning, like everyone's projecting margins to improve when, it was just like a one-time benefit. Or you can start to see inflections, right? Like something's accelerating, like revenue growth might be accelerating. That could be an idea. Like I'll give you an example, like, so MSCI, so that was like a good idea, I think, like from my team. So I mean, last year, right? So ESG was starting to take fold. So the general idea is like, okay, so ESG is starting to take hold. This could be interesting for MSCI because they have a decent ESG business, right? And so that's just sort of the inkling of the idea, but then how to turn that into like a real investment thesis. So that's where I can dive into, like, this is, one of the ways you can do it, or what's one of the ways we did do it. Well, so we looked at the ESG business, right? So it's a small component of the business, but, from management, what they're saying in management, right? CEO Henry Fernandez says that, the ESG business could be just as big as the index business. Index is one of the businesses in MSCI, right? So immediately that's like your clue, like, all right, so they're strategically thinking of this ESG business could be really big. And then you can start to do some, a deep dive analysis of what ESG really could be in terms of the investment industry. So then you go look at, like, you look at organizations to figure out how big is ESG going to be. You find out that literally every single asset manager has pledged to adopt ESG practices. You start looking for information of, like, how penetrated is like how much or what percentage of assets are actually using ESG. And so you can start to put together like an industry trend. And so that's when you start to put together the data, you can start to see things that maybe is not as widely known. And then, and then you can, and part of it's like, you want to be a little creative because you never know the right answer, but you try to figure out ways, be creative of using your analysis to figure out an answer. So for ESG, what we did was, we saw that there was a certain percentage of ESG, probably 20% max of total assets. We know it's like 100% of assets are going to be ESG. So, like, how quickly is it going to be adopted? So what we did is we used a model of, borrowed it from tech, of the BAS. So it's like some sort of BAS model, which is like a product adoption model, and literally just applied, it took some finagling, but applied the adoption of ETFs and indexes, because that was widely adopted, applied that kind of rate of adoption, assuming institutional investors are going to adopt things at the same rate as they used to,
right?
Applying that to the adoption of ESG, and kind of from understanding the MSCI business model, that way we could start to size how big ESG would be as for the business model for MSCI. And, from there, then we know, okay, so here's how we can literally model in this business into the earnings estimate. We can start to see, all right, growth is going to accelerate 22, 23. And then how do we value that, right? So then we see this as like a very highly cash flow generated business. And then we have to be creative, like, all right, so how are investors going to value this kind of really free cash flow growth company with accelerating earnings from a new, hot area and markets? Like, how's that going to be valued? Maybe something at least like as like one of the top, or at least in the same valuation framework as the S&P 500. So without getting into the details, like, that's how we could get up. We went from something like 320 last year, and then we got to a target of 500, right? Which at the time was like crazy, right? Everyone's like, MSCI is way too expensive. Like, no, this is going to 500. ESG is going to change this business, and I just looked at today. It's like, today it's 520, right? So that was a good call.
I was looking at it, and I was like, wow, that's pretty quite impressive returns over the last 6 or 7 years. I think 500% or something, and it's just been like this smooth line, It's a really good stuff. So I mean, beyond MSCI, when you guys are actually conducting your research, so you guys get access to management teams. Do you always get access to management teams? Maybe one.
I mean, so it depends on the company, right? And I'll also say that, like, Wall Street or institutional investors, you have access to management teams, but the way the regulation is, they're actually quite good about not saying things that are not public. So it's not as big of an advantage as it seems. It's very helpful. But with transcripts and whatnot, you can still get the same level of, insight. But generally, yeah. So we speak to management teams at least once a quarter. If we take them out to see investors, we're literally, in the car with them.
Really? That's interesting. That's interesting.
Yeah.
Sometimes you guys are actually taking these management teams to see the buy side sometimes too.
Pretty much. Yeah. We're literally driving them around to see an investor.
I know you talked about you bet a couple of teams. What were some of your biggest high points of like management teams you met during your time?
I saw a couple. I met all of them. I can send you my coverage universe, but Henry Fernandez, I think is a real visionary in MSCI. I'll say he was a great one. Like I thought AMN was
the really guy at Chegs.
Huh?
The guitar guy at Chegs.
The Guitar Hero guy. Yeah. So that was So Dan Rosenzweig. Those guys, like, they really executed quite well.
Yeah.
That was great stock. He seems like he's a really good manager, and like they executed a very good vision. Yeah, there's like Chegg. I guess if anyone doesn't know, it's Chegg's CEO. They transformed the business from like a textbook rental company is like a multi-billion-dollar student services company right now. It's pretty amazing.
Yes. Very cool. And then I know obviously everyone has access to S1s, 8K, 10K reports. You guys are probably digging through those as well.
Yeah.
But one thing I've actually just discovered lately is the value of expert reports. So I wanted to get a little bit of insight from your perspective. Did you ever do expert recalls? So I'm just wondering about non-traditional ways of researching companies, because beyond your S1s and industry reports, did you do expert calls? I know you briefly talked about consultants, discussion. So it's kind of wanting to get a little bit of size just for anyone who's listening to this who might just be interested.
Yeah. So the answer to that is yes, we did use expert calls. But to provide context to that answer, like what you're trying to get at is like, okay, so how do you get an edge in investing, right? So, expert calls, trying to get additional information. This is just my view from my experience. I would say that that's not as valuable as it appears to be, right? Like having an additional information, it's so competitive right now in terms of people doing that, like even with like alternative data, credit card data, and so forth. It's actually not that straightforward to just have extra piece of data means I know where stock is going to be. Mm-hmm. If anything, I would say, like, if there's three basic sources of edge, like one is information, I would say the other two would like the other two are, analysis, that you just can see things differently and put together the information differently and see the truth, better, or, like you could behave differently from other investors, and you can learn to buy and sell, at times that people are selling and buying, right? Like, you're buying during panics, or you have the kind of ability to sell when the stock, reaches its full potential. Right. But yeah, no, I would say experts, because the thing with experts, right? Like they'll tell you, they can give you like a really good understanding of like what's going on in the industry, what's going on in the business model. But like the kind of art of investing is like you're not dealing with the industry, you're dealing with the stock, right? And the stock is something that reflects change and it reflects expectations. So they might not even be that useful to. So to your point, it depends, I guess. It's not a very good answer. But...
Yeah. No, very good. No, that's fair. That's totally fair. Another question we got was, and this is kind of a very interesting question about, do you think a lot of sell-side equity analysts are really short-sighted? Because when you buy stock, you're hoping to hold it for the very longest horizon, right? You have a 5-year TC. So over the next 5 years, I think the stock is going to be X and Y.
Yeah.
Well, a lot of the price targets we see up on the news and headlines are primarily about this 12-month price target. So do you want to give our viewers a little bit of insight into why analysts are, do you, maybe first of all, do you think they're short-sighted ones? Did you ever think about that in the industries? We're a little bit too short-sighted, one. And the number two, maybe give us a little bit of thought process into how you guys come up with those 12-month price target. Because as I mentioned earlier on, those price targets get a bad rep on, especially among retail. So maybe give us some insights into how you guys do look at those.
Yeah, sure. I mean, so I'll just say that like this idea of like Wall Street being short-sighted, I don't think is necessarily that. It's not widespread short-sighted, because if you look at like, you know, like a company, like any company like Tesla, Snowflake, right? Like we're talking about companies that are like not making money, right? And really, if you're underwriting them and there's a lot of institutional investors buying them, like you're buying them for like 10 years out. So like the idea that if you were short-sighted, it's like when you have like when stocks are being sold for no like profits, it's like it's actually opposite. Like people are very long-term focused. But to your point, in terms of like these one-year targets, it's just unfortunate. Yes, it's an unfortunate thing of the industry. It's just how it's structured that like it flows back to hedge funds and institutional investors, right? So they like they're paid by one-year performance. So if a hedge fund is down 20% in a year, like it's flows are coming out of or capital's coming out of its fund. Even like, yes, you know, Fidelity, right? Everyone says like, oh yeah, you should hold on for 3 years. If they're down 10%, people are going to pull their money out.
They're fired, yeah.
Yeah, they're getting fired. So it's just an unfortunate consequence that like, as an investor, I mean, this is why it can be an advantage for the retail or individual investor. But as a professional investor, you kind of need to be right within a year and a half.
Yes.
So, you know, as a sell side, we, you know, provide research and help people to get there. Unfortunately, it means coming at one-year price targets. But it's not, I wouldn't look at those targets as like, it's more like your thought process how to get there, as opposed to like, you know, those targets by themselves they're not that meaningful, in my opinion.
Exactly. And I mean, maybe it makes a lot of sense. I mean, your biggest clients are not really retail investors. Your biggest clients are the hedge funds, who are measured by, they have these performance targets, right? And exactly. So they're publishing this report for these folks, and obviously they need to give them a good sense of where they think the stock would be over the next.
Exactly.
That's interesting.
Yeah. It's tricky, really, right? Yeah, because you know we're providing research to like someone who is both wants to trade the quarters and trade the year, right? So they're caring about like quarter to quarter performance, but at the same time, like we know that like this might be a really crappy quarter for a company, and like it'll just the stock's gonna go down. So like it's our job to share that around, but like we also have other clients, right? Like we're not going to tell the bankers and the company like this, sell all this stock. We're like, we understand too. It's like a good stock. But like, so then how do you say both of those things? Exactly. So that's why it's like, I think that's why everyone hates sell-side analysts, right? Because they're trying to please so many people.
Yes. Interesting. I always wanted to ask this question about, are you guys measured on your price targets? You know, I've always been curious about that. Is there some kind of an internal metric whereby if, I don't know if maybe this is a reward centric way of doing this, but maybe I might be wrong, I might be right, but maybe if our analyst came out today and put a buy on this one stock when it was $20 in January, and at the end of the year it was about $100 or $80, if there's different analysts on the team and one consistently has an outperform and consistently hits those targets, maybe the price actually does hit those targets before the end of the year. So I'm just curious, is there some kind of an internal reward metric? And maybe that might, because sometimes you see certain situations whereby stock is down 10, 20%, and the analysts just come out real quick and like, nope, bank, we have this price target on this stock on a day when it's down, right? You know, and it's almost like, is there some kind of a reward metric, or is it just kind of random? Is it just more I'm just wondering, what's the reward metric like for you guys, and do those targets play a role in those rewards?
Yeah, well, I mean, so sell-side research, I mean, this is why unfortunately it's a shrinking industry. It's based off commissions, from trade commissions. So how the business works, everyone has their own style, but generally you want people to want to talk to you. So it's either you're very thoughtful, you have a lot of things that make people think, or you're just a person that everyone actually likes to be around. And some analysts are like that, right? Like they're very good at taking investors out, and companies love to travel with them. So that's so you get paid off those meetings, right? Or you get paid off really thoughtful stuff. Everyone wants to talk to you. And then obviously the final one, to your point, there are analysts that everyone likes them because they help them make money.
Yeah.
But with sell-side research, because like you're not necessarily going to the sell-side research to be like, hey, literally tell me what stock to pick and tell me when to buy and sell it, right? Like that's, it's sometimes people do that, but really it's the research is supposed to be there to like help everyone, come make those decisions. But the sell-side research person not really be paid on making those decisions. It's the buy-side person.
Yeah, very cool.
Because they have their own strategy, right? Like, so
yeah,
they have to tailor it to their client.
Exactly. One other question would be about groupthink. Do you think there's a lot of groupthink because in the industry, in the sense that everyone on every stock, at least, you have almost everyone's congregating around a buy, or I think Tesla today might be one of the most diverted stocks on Wall Street today, especially among analysts. Like there's like a huge divide between the buy and the sell. I think those are one of the few examples, but for lots of stocks, you just have this feeling. It's almost like if you could plot a graph, you could almost see everyone's trying to congregate around, So why do you think there's that groupthink mentality within the street? And do you also think why isn't there a lot of out of the box thinking? Why are more analysts not bold to say, hey, you know what? We have a buy on this stock that everyone's trying to sell, or the opposite of it, because I think during the Enron crash, a couple of companies that went bankrupt, a lot of people blamed the sell-side equity analysts for that. Hey, all these analysts had a buy on this one stock, right before it crashed. So give us your perspective on groupthink and a lot of that out of the box thinking.
Yeah, I mean, it's a good point. I mean, I think it happens like not even on the sell side, but also on the buy side too. Like a lot, like there are trends. Like there's hot stocks that everyone thinks is best thing since sliced bread, and everyone tends to congregate around what management says a company can achieve. And I don't know if it's just sort of inherent, I think, in markets, right? Like there's always trends. I mean, I guess it's unfortunate, that sometimes analysts are just not there to see like an Enron. Though I don't think anyone really saw Enron except like maybe David Einhorn. But sometimes you get trapped in the bubble, I think, right? Like sometimes you're so trapped in, you're always just thinking about the quarter, you're looking at the annuals and you're modeling, you're talking like you just, I think for anyone in the business, you're just so used to just doing the day to day and you're hustling that you don't take a step back, which I guess is like what happened in the financial crisis, right? No one really taking a step back. Is like, all right, this is not sustainable. Like all this credit is not being backed by real cash flows. It's going to be a problem.
Exactly.
So it's unfortunate, but
yeah,
I mean, happens, everywhere.
It does. I mean, it kind of reminds you of what happening with commodities right now, right? I think we had a little bit of a conversation around this last year. There's a lot of ESG talk, right? Right up to even January this year, and then everyone didn't want to own the commodities or any of those, and then all of a sudden you just had a flip, right? The fears of inflation came up. So
it's like so funny. It's like, but last year everyone's like, oh, ESG is going to take over. I mean, this is actually an institutional thing. Like ESG is taking so much capital, and oil just went negative, right? So everyone's like, this energy sector's done. Like BMO shut down their energy banking, like really literally like shut the entire. It's like the bank was built on that, right? but like now, right? Like in the beginning of the year, it's like, oh man, you got to sell growth. These tech companies, like you sell them, they're never going to perform ever, right? Because all these value stocks are performing. It's like, it's all about commodities. And then now it's like, okay, CPI prints a little bit less. And now it's like, oh my God, now cyclicals is not working. Growth is coming back up. It's like, it's just little waves of things. Like
Exactly.
things haven't changed that much. But then the narrative is being influenced by the market. It's not the market. The market's just doing its thing, you know?
It's wild. Yeah, it's crazy. It's crazy. So maybe we'll talk a little bit more about some insights from your book.
Sure.
You know, and let's just maybe hear from your perspective, you know. So one of the things I really like about your book, as I mentioned, and I think people should definitely check it out, because a lot of these insights that we've just even gone through right now, you give a lot of highlights in the book, you know, and I think people would do really well. So from your perspective, I mean, in the book, you talked about what makes a good investment ideas. And I think I love how you broke that down into key components, and you give a good example with Upstart as a good example. So maybe kind of just walk us through from that equity analyst perspective, you know, what makes a good investment idea in your opinion, and what are some of the important components people should learn?
Okay. Yeah, sure. Yeah. So, I mean, so one of the big takeaways, you know, that I learned from, you know, from sell-side research about investing is that there's actually, you can break things down into a structure. It doesn't mean like, you know, I'm going to talk about Upstart. Doesn't mean I'm going to be right, but there are certain elements of an investment idea that are consistent, and there's a structure to how markets work. So, I mean, just breaking down Upstart, like why I think it's an interesting idea is, you know, one, like it's very clear what the bet is, right? So for Upstart, it's a bet on this data science, you know, AI driven credit decisioning model is going to be better than a regular model, right? And that's their pitch, that, you know, a bank can issue more personal loans at a lower loss rate. And then, so that's one, it's very clear the bet. And two, in terms of like, there's also like some disagreement around it, that a lot of people might look at Upstart as just like another like lending club. It's another lending, another startup lender that's just going to eventually get bogged down with bad loans. And so, I mean, it's one is clear what the bet is, and two, which I would kind of just broadly consider under a framework of there's change going around, or there's some change that is reflected in the stock. And then in terms of like upside, the upside, if this model can work, and it's being distributed to different banks, like what makes that interesting is because then the addressable market can be really big. And so depending on how you kind of break down this market of, you know, say personal loans and auto loans that they get to, you can start to build out models that suggest like they can get to at least, you know, I think I have my model, which is obviously a very optimistic model, like aggressively, you know, what this company could achieve, you know, gets close to like 5 billion in like 2026, like the next 5 years. So that's a pretty significant runway for growth. So that's just, you know, the change aspect, there's the earnings aspect. And then, you know, just the way the markets work right now, so many stocks are driven by factors. There's the macro. And so why I think it's interesting for Upstart is, you know, it's the business model is driven by, in my mind, interest rates, because interest rates, when you have higher interest rates, usually it means more credit. You're making more money off issuing credit. Interest rates tend to increase at the start of a business cycle coming out of a recession. And so this stock will naturally be considered a financial stock. So, you know, being that we just come out of a recession, interest rates, you know, looks like they've come down a little bit, but they might go up just from growth.
Yeah.
And historically, financials have performed well in an early cycle. So those are kind of the factors like, okay, I want to have exposure to those factors with Upstart. And then finally, you know, like we can talk about this as well as like in terms of the business model, you know, the business model is based off software. And, you know, I guess we can debate whether or not some of their costs are going to eventually come down, or, you know, like technically their cost of, they acquire loans themselves. Right. But right. In general, if this company is really a software model, then, and it really can accelerate growth in the number of transactions that it processes, you have a very leveraged model, right? So that's just another thing in terms of like looking at a business model. If this is a software business model that has a lot of leverage, it could, could generate a lot of earnings, which usually means a very good situation for the stock. So that's just like an example of like some of the elements, hopefully I kind of laid out, which make like what are some of them that make a good investment idea.
Exactly. And if I could break it down the way you did in the book, it was more around, you want to consider the business model itself. You want to make sure you have a really good understanding of the industry itself, kind of that industry framework. A third component rather was the cycle, the business cycle, as you mentioned, right?
Exactly, yeah.
Up or lower, you want to think about those, and definitely multiples and kind of what that industry comes.
Yeah. So I guess I should go back to the actual strategy. So I mean, you can kind of break it down to each of those things, right? So we talked a little bit about the cycle. So the cycle, it's got financials, it's got rates. Those are positive from the macro kind of template, right? Then let's look at the business model. So the business model, we know that it's driven by transactions. Technically, its business model is not driven based off taking on credit risk, ideally, in terms of this business model. So then that's a business model. Do I want to bet on that? Is that the kind of business model that could have a lot of earnings upside? In my mind, that suggests to me it does, right? And then in comps, right? Like, so in comps is interesting because you want to use, comps are a way, which is, it's more of a practitioner way to value a stock and try to get a sense of where it could go. And so for like a company like Upstart, really what you're kind of betting on is that this could turn into something like a FICO, right? And FICO is used by, I don't know, close to, it must be like 100% of banks in terms of issuing credit. And so you want to use a multiple of FICO and maybe like another high growth fintech company like PayPal. And so then you get to like a 10 to 12 times revenue multiple. Of course, assuming that Upstart will kind of have the same sort of profitability as FICO and PayPal. And so that's how you can get to a target. In my model, I get to, something close to like 170-ish in terms of present value, in terms of like the earnings potential for the next year. So 1 year target. And then the industry framework, like you said, so as you, part of estimating an earnings upside for a company requires you to understand whether or not it can keep its profitability. So we do outline some things, some frameworks that you can use for this one. I mean, for looking at industry, but with Upstart in particular, it seems like this could be one of these type of companies where, in terms of the industry, they're pursuing like a very Google-like model. Like they want to insert themselves in the ecosystem. And so this might be a framework where if this technology is used for every single transaction, all of a sudden that's like that's a very powerful kind of component of being embedded in the financial system. And that would be very, very valuable.
Right.
And so that's just like an example of one of the frameworks I was using. But again, it's obviously we're dealing with probabilities and chance, but.
Totally. No, that was good. One of the thing I really loved about the book is you really talk about the most important component for a stock, right? You talk about how, and maybe you could give our viewers a little bit more some perspective on that.
Sure.
That whenever you're thinking about investing, whether it be in stock or industry or anything, you always want to think about the rate of change. You always want to think about change. And I feel like that's like a first principle approach to investing that people really need to understand. Do you want to talk a little bit about the rate of change and the importance of understanding catalysts? Because those I personally, I really could relate. I could really think about that because I think it's so important to know when a company re-rates. It could be the valuation, right? There could be one tiny component that just re-rates a stock completely.
Yeah.
So maybe talk about that foundational element of rate of change and why that's important for investors to know that.
Yeah. So if we really take a higher level view, which is where we want to start off with, investing is, it's really about change, right? Something is changing, and the stock will change because the stock reflects the future. And really, if you look at any sort of long-term view of a stock and its earnings, or a company, it's going to be earnings and stock. It's just going to go the same way. And so because you're looking at change, right? You're not looking at things on a static basis, right? You're not looking at, this company has made $100 this year, and then,
That's all.
like the more importantly is like, is this change, is this company growing at 100%, or is it growing at 50%, right? Because we're looking at change. So we're looking at essentially the direction of where this company will go. So that's sort of the first basic principle of analysis, is you want to be looking at everything from a rate of change perspective. Because obviously, if a company moves from growing from 5% to growing at 50%, if you grow 50% every month or every year, like just from the exponential growth of that, that just purely on earnings alone, like the difference over the next couple of years is going to be really big. Like it's mathematically exponential. So you want to be looking at rate of change. You want to be looking at just change as a framework for investing. And then, like, you brought up catalysts. And so that's just something that is unfortunately not as used outside of Wall Street, even though it's like a very fundamental principle, I think. So catalyst is, if we're looking at a stock and it reflects future change, and we're analyzing it through the rate of change to see where the stock can go. Now, there's always new events happening in the market. There's always new news happening in the market. And sometimes there's just something that people are missing about a stock. So those are the kind of things of like some sort of change that will impact the model. And you brought up things like, you want to focus on some sort of critical factor, right? Like generally you want to be focusing on things where a catalyst will create a meaningful change in earnings estimates, essentially. So like an example is, just because there was so much change this year and last year, like there's a lot of catalysts that were like very obvious. So like, for example, like retail reopening, right? Earlier this year, it's very clear that reopening would be a catalyst. It could be a change. Yeah. And so you could look at certain stocks, like LB is one stock that I highlighted. There were just clues of the catalyst just every quarter. They would say like our gross margins are better than expected. We're seeing some pent-up demand. And so those are signals to you of a catalyst. And if you can build out the LB model and you kind of look at historical trends of where retail sales could go based on, pent-up demand and where it used to be pre-COVID, you could start to apply that change of reopening, apply that to the financial model, and compare that to earnings estimates of that company. And you can see that, earnings estimates need to go up almost like by 2x, like they needed to double, which they did. Exactly. And so that's sort of like in practice how, how like that's in practice, how do you like analyze a stock in a certain way that will make you money? And that's sort of, I guess what we kind of touched upon.
Yes, perfect. Yes, that was good. Totally. And let's move. So this is another component of the book that I found interesting, was you kind of went from rudimentary foundational components, right? Mm-hmm. The things you want to focus on, EPS, your cash flows, what's an income statement, a balance sheet, like those terminologies. And then you took that over to the advanced level. So I think we've talked about some of these foundational elements. Maybe just give us a little bit of a brief highlight on the advanced concepts components of the book, right? So one piece I found really interesting was positioning by institutional investors. I think that's pretty interesting because I think that's where, if you could nail down positioning prior, like we talked about commodities being underowned, right?
Yeah.
Or at a specific time last year in 2020, technology was maybe a little bit underowned. You could never say technology has been underowned over the last 10 years, but you could maybe see there were sections where, oh, the market was like, oh, well, yields are going to go down, rates are going to go down, the Fed just acted. So growth, the multiples are going to go higher. So we got to own growth, right? So those positioning concepts, I think, are huge because if you could nail down those, you could make a lot of money, right?
Yeah.
So maybe give us a little bit of highlights on the advanced components of the book. We've talked about foundational, but talk about some of those lessons from that side of things.
Yeah, sure. So so we talked a little bit about, the principles. There's stuff in financials which, I guess we don't need to talk about those. It's interesting, but they can kind of get you in a certain way. But yeah, if you want to when you get to the advance, right? Like, positioning matters a lot because really, if you look at the structure of how stocks move, right? First, it's the ETFs that are moving things, right? So that's why the sectors and the macro are kind of a key component of what's going to make the stock move. Yeah. But then also, like, what's going to make it really move is like you want a big investor to start buying it up, push up the stock. And so positioning, like, we brought up commodities, last year, oil prices went negative. ESG started to become a very big part of the investing landscape. And so there was just literally a withdrawal of capital from all energy, like so many energy funds. And, you see that with energy businesses shutting down. So, what that does is it creates a scenario where, everyone is under position. That's sort of the term. You're under position in energy. So everyone is underweight energy. And, if they have like an index of what they're supposed to invest in, they put in 0 in energy. But then what happens, I guess what did happen is, oil prices went from 0 then to 30 and then to 60, right? So then that naturally leads to energy companies, even if you don't like them and you don't like energy companies like that, now they're making a lot of money. And so then that boosts their stock returns because, eventually a stock will start to return, a stock's price will start to reflect a lot of earnings coming in the future. Exactly. And so then all of a sudden, now if all these energy stocks are going up and everyone's seeing that they're getting like 10, 15% returns, they're like, oh crap, like, I'm not invested in energy right now. I need to put money in energy. Yes. So you see that as literally an institutional shift. So they all realize like, oh, we need to put our money in energy to get those returns. And then that just drives it up even further. So that's, to your point, I mean, that's what actually a lot of professional investors try to do as well, is to try to find information of like where people are underpositioned, where they're overpositioned. And then you can maybe even start there to come up with investment thesis. Mm-hmm. I mean, that's the thesis for gold right now. I mean, I'm not sure if that's going to work out, but that's how some people are pitching it right now. It's like everyone, global investment firms have less than 1% in precious metal equities. And then, that would be the thesis. If gold goes to 3,000, then there's going to be a lot of people investing in gold.
Exactly. Very cool. Was there any other advanced concepts you think are very important for investors to know about, just in general? Or maybe this is kind of towards my last questions as we wrap up now, would be, what were some of your biggest insights from dealing with institutional investors? It could be the buy side. What were some of your biggest lessons that are like, oh, it's just some aha moment that you think maybe a lot of retail investors don't know as much, So some of those big insights that you could say would be maybe helpful, maybe it could be lessons or...
Yeah. I mean, I could think of two, which I think are, so I'll think of two. Like one is just one is like industry kind of analysis, or just how to think about an industry, and the other one is like the behavior of institutional investors. So like taking the like industry stuff, I mean, you can tell me I'm wrong, but I feel like one of the things is an individual investor. Everyone says it's like, oh, you gotta look for cheap stocks, right? Like it's actually completely wrong. Like, you don't want to focus on valuation really as your primary factor at all. If anything, you look at actually how companies work, it's actually the industry that's going to be the biggest driver, whether or not its earnings are going to really grow. And like an example that I speak about is like, take a waste company, right? Like you have garbage trucks collecting garbage, right? And then you have them putting into landfills. Now, a business that is based off the trucks collecting garbage is very different from a business based off landfills. And part of the reason is because if you look at the industry structure of landfills, like no one can build a landfill. Well, maybe, I don't know, probably not in Canada either, right? But like in the US and Canada, no one can build a landfill. And then, you look at the data, like waste, population keeps growing. So waste keeps going up, even though like, per capita waste is going down a little bit.
Yeah.
Even, like people are recycling but in any case, like volume waste goes up, landfills, no landfills, landfills even going down, right? So what do you think is going to happen to prices of landfills, right? They just keep going up, or at least they steadily go up. And so, so any company as a waste company has built its business around owning a landfill can like have really, really high returns. Like there's like a company called Casella. They operate landfills in the Northeast in the United States. Obviously like highly dense, no landfill space. This company did like a 10x over the past 5 years. And so it's like, but it's also like at an 80 times PE. So it's like this idea of picking so valuations makes no sense. You really got to look at the long-term earnings potential. And that comes from just understanding industry structures, and certain environments create very, very profitable earnings. So that's just one thing for like industry structures.
And then behavior. What's the next one?
Yeah, behavior. Yeah, so behavior is just, I mean, you can use, like once you understand how the different funds operate, you can use that to your benefit. So ETFs are like 50% of assets right now, the predominant driver of flows right now. And so like we all know what ETFs do, right? They invest based off the index. Now the index, how you invest on the index, if a stock goes up in value, you're going to buy more. So that's just another clue that like you cannot invest on things or not invest on something just because you think it's overvalued or it's expensive. Like, well, one, you have to figure out whether it really is overvalued or expensive. But two, just because something has gone up, it actually means in this kind of market that somebody's going to buy more of it. And so, then you can look at the shareholder list, right? And you can see like, all right, if this company is owned by a lot of ETFs, it might be driven more by flows, like we talked about in like macro, or the prices might just have a lot more momentum because people are buying, or the ETF's buying more as the price goes up.
Yes.
And then the other thing is like, right, like hedge funds, long only. So when you see names like Fidelity, Wellington, T. Rowe, like these are very, very good investors. They spend a lot of time researching the stock. So they're interviewing management teams. They're doing like 3 to 5 year type of estimates. Yeah. So when you see them on the shareholder list, like you can kind of use that as like, I mean, they're basically giving you research for free in a way. Like you can see their list. You're like, all right, this is probably a decent company. Definitely not a fraud, ideally. I mean, but like, I don't know. I guess we could check if Wirecard, like if Fidelity was invested in. I would guess maybe not, but we'll see.
Yes.
And then hedge funds, like if you see a hedge fund, I mean, you won't see like a Citadel, but if you see a hedge fund like, what's it like Whale Rock or Lone Pine, right? These are guys that are invested for catalysts. They're invested for like real change. They're trying to get, returns over the next year, or at least the next 1 to 3 years, right?
I would imagine like your energy companies or commodities would be driven by the hedge fund guys because they're looking more short term and they know this is going to be up for a short time, right? And they're wanting to get in, boost up performance for like the short term, as opposed to like a T. Rowe or Fidelity that they're looking way more long term, right?
Exactly. Yeah. Those so I would guess with the energy companies that are coming up is a mixture of the ETFs and hedge funds.
Yes.
Yeah.
That's interesting. Industry structures and behavioral change. Yeah, I absolutely love that. So just to wrap up this interview, what would be your biggest advice? Like if you maybe had 2 or 3 big advice that you could just from your career over 10 years, just dealing with management teams, institutional clients, and just all the research and everything on Wall Street. I mean, what would be 3 or 2 lessons that you would maybe want to give someone today? Or it could be a retail investor or anybody, or it could just be lessons from your own career that when you sit down sometimes and reflect, you're like, this is like a big lesson, and I really want to pass that over to people.
Yeah. I mean, I guess first lesson I would say is that it's possible to do well investing as an individual investor. I think it's 100% possible, right? Like the information's out there, and I would really suggest or like tell you from experience that it's not like everyone on Wall Street or like the professional investors that really have that much of an edge over you. Like if anything, if you're going into this thinking like, oh, like I don't know anything, I'm gonna lose money, like it's not, you don't really want to have that attitude. Like you kind of want to, you know, you want to be careful, but like you can do it. That's sort of like the first kind of message. And two, like honestly, I would just be careful about like listening to like people who tell you like strategies that they say will work, because strategies is one thing that changes over time, right? And everyone has their own personal style. So the other thing I would say is you want to try to go for principles, if that makes sense, right? Like try to understand the structure, the principles. And so then it'll just help you just find, what you like, because some people like picking value stocks and those work too.
So this could be around investing strategies, right? Pick a strategy or principle that you really love, or I guess you really understand, right?
Yeah. Something that makes sense to you, right? Yeah. Like, like even value, right? But value, what you need for value is it's not just screening for a cheap stock. Like value means like you're looking at something that no one really likes and you're betting on a change that'll just change the business, right? Like GME is like a perfect example of a value trade. Like it's trading at like its cash levels, and obviously it was Ryan Cohen coming in. You're betting on Ryan Cohen, right? Mm-hmm. Or if it's like you want to be a growth investor and you like C Limited or whatnot, you think that this is going to be an e-commerce play on Southeast Asia. So I would just say that like whatever style you want, like just have a sort of structure to how to think about it, right? Like the structure that like earnings are going to get around to this level, and I think that like this company will grow to this level, like at its most basic form because of this change, right? So to move away from like I really like this stock because it looks good, and like yes. I would just say just use some structure in your thinking, and it'll help a lot.
That's awesome. One question here for you would just be, what's one stock you're really excited over for the next decade that's maybe could be your biggest portfolio, or there's just one company you're really excited about for the next 10 years?
Yeah. So my biggest holding for my personal portfolio, and again, this is not investment advice, not financial advice. Like everyone should be picking in, like I like aggressive growth kind of things. But I like SC a lot, right? It's C Limited. Like it's pretty amazing that this company has it's got an e-commerce business, it's got a gaming business, and it's got a financial, it's got a payment business all in one in a market that is, still early on in its e-commerce digital penetration, and has a seemingly like a really, really intense focus on growth in the company. Right. It has a lot of positive signs, right? It's got insider ownership of like, managers that own most of the company. It's got very high growth. I guess one thing is that, they're raising capital, so it might be a little dilutive, but like the potential seems like, you're really getting three very high growth businesses in one.
Definitely. Awesome.
And so I think that one's pretty exciting. I got some others, but we can talk about that another time.
Sure. Where could people find your book? Maybe to give us some insight. Where could people find your book?
Yeah. So we'll have a link in I guess in the bottom of the page, but otherwise you can go to henrychen.com. There should be a link for the book there, or follow my Twitter, which is Henry Chen. I think there's a 4 after it. Yeah, Henry Chen with the letter 4 or the number 4. There's a link, and you can take a look at the book.
Perfect. And I think you could find it also on Gumroad too.
Yeah. There's a Gumroad book. Yeah, that's where the link is. You can get the book digitally, get it online. There's a table of contents there, as you can see that all the principles and tools and concepts that we kind of touched upon here that can really help help accelerate the learning and, make money in markets.
Absolutely, which is a big goal. Awesome. Look, thank you so much, Henry. Really appreciate your time and just sharing your insights here over this interview. Thank you so much, and I definitely recommend everyone should go check out Henry on his website as well as on his Twitter channel. He has a pretty good DM as well, so I think that'll be good. Thank you, everyone, and please give a like to the page if you want to get future videos about content like this, or even specific company ideas on this YouTube channel. So definitely give it a subscription. But with that, thank you very much, Henry. Thank you, everyone, for joining us, and have a good day, you guys. Thank you.
All right, thanks.